Hello friends, welcome to Weekly Recap China edition. We follow all the news so you don't have to. This week's topics are Taiwanese elections complicate international relations, China's deflation problems deepen, Chairman Everbright arrested, China becomes world's largest auto exporter. But of course we begin with a quick look at the financial markets and other financial news. The Shanghai Composite Index decreased by 2.09% and closed at 2,834 on Wednesday. The benchmark reached a new multi-year low as investors reacted to important news from China. The country's economy grew by 5.2% year-on-year in the fourth quarter, which was slightly lower than the forecasted 5.3% expansion. On the other hand, China's GDP for full year 2023 increased by 5.2%, surpassing the government's 5% target. Retail sales growth in December was below expectations. China's 10-year government bond yield remained calm at around 2.5%, staying close to its lowest level in over 2 decades, as the latest economic data provided little indication of the future direction of domestic monetary policy. The market is uncertain whether Chinese authorities will implement further policy easing due to the depreciation of the yuan. However, the deflationary environment and the ongoing economic recovery continue to support the possibility of easing measures. The decline in the market was led by consumer-related and new energy stocks. This week's financial news includes the yearly inflation numbers and China's trade surplus. Let's start by examining the inflation numbers in more detail. China's consumer prices decreased by 0.0% year-on-year in December 2023, making it the third consecutive month of decline, which is the longest period of drop since October 2009. The figures were lower than market expectations of a 0.4% decrease, showing a moderation from the sharpest decline in 3 years of 0.5% in November. Food prices saw a smaller decline compared to November, mainly due to a softer fall in pork prices. On the other hand, non-food inflation slightly increased, with costs rising for clothing, housing, health, and education. However, prices for transportation declined at a slower rate. Core consumer prices, which exclude the prices of food and energy, remained unchanged with a 0.6% year-on-year increase in December, the same as the previous 2 months. For the full year, consumer prices increased by 0.2%. Monthly, the consumer price index slightly rose by 0.1%, indicating the first increase in 3 months, but falling below the consensus of 0.2% rise. China's trade surplus increased to $75.34 billion in December 2023, surpassing market forecasts of $74.75 billion. It was the largest trade surplus in 3 months, as exports grew more than imports. Exports rose by 2.3%, beating forecasts of a 1.7% growth, while imports edged up by a 0.2% compared to the market expectations of a 0.3% rise. For the 2023 full year, the country posted a surplus of $823 billion. Because of challenges, China's export fell 4.6% to $3.38 trillion, while imports dropped 5.5% to $2.56 trillion. The trade with the US was $664 billion in 2023, down 11.6% from 2022, which marked the first decline since 2019. On a positive note, trade between China and Russia reached $240.1 billion, hitting a new record high in 2023, growing 26.3% from a year earlier. In a pivotal moment that could reshape the geopolitical landscape, Taiwan's recent presidential election saw the victory of Lai Ching-te, the candidate most distrusted by China, posing a significant challenge to the delicate balance of relations between Washington, Beijing, and Taipei. Lai Ching-te, along with his presidential running mate Hsiao Bi-khim, secured a win that cements the Democratic Progressive Party control for another 4 years. The victory is seen as a direct challenge to Beijing's aspirations for reunification, as Lai is rightly regarded as a proponent of Taiwanese independence, a stance opposed by mainland China. The election of Lai sharpens the focus on Taiwan, a democratically self-ruled island that stands at the heart of the strategic rivalry between the United States and China. President Biden, aware of the situation's delicacy, has reiterated that the US does not support Taiwanese independence, aligning with past American assurances to Beijing. However, the US State Department's congratulations to Lai indicate an intention to deepen ties with Taipei. China's response to Lai's victory was swift and dismissive, undermining his legitimacy and vowing to continue its efforts to assert control over Taiwan. This stance signals a potential escalation in economic, military, and diplomatic pressures, including tariff measures and combat drills. Such actions could further strain the already fragile US-China relations, which have seen some improvements following a series of diplomatic exchanges aimed at reducing bilateral tensions. The election results puts the recent rapprochements between the US and China under significant strain. While both nations are competing for global dominance, neither seeks a direct crisis. However, Lai's upcoming presidency, set to begin in May, demands careful navigation from all parties to avoid escalating tensions. Lai's victory speech emphasized maintaining the status quo and working with political rivals, potentially signaling a more moderate approach. Yet this might not suffice for Beijing, which views the DPP as a separatist force driving Taiwan towards conflict. The US, Taiwan's main defense ally, has built strong ties with the current president, Tsai Ing-wen, and may find Lai's approach to independence more concerning. The Biden administration's response, emphasizing stability and peaceful resolution of the differences, reflects a cautious approach. This stance was underlined by the visit of retired US officials to Taiwan following the election, a gesture in line with past practices. However, Beijing's potential reaction to Lai's victory remains a significant concern. A forceful response could prompt a US rebuke, leading to a downward spiral in US-China relations, just months after efforts to manage differences more effectively. This delicate situation requires a balanced approach, as any misstep by Lai or aggressive military posturing by Beijing could disrupt the fragile equilibrium, pushing the regions towards increased instability and conflict. As China steps into 2024, it faces a challenging economic landscape, marked by slowing growth and persistent deflationary pressures. According to a Reuters poll, the country's economic growth is projected to decelerate to 4.6% in 2024, and further cool down to 4.5% in 2025. This slowdown comes on the heels of a 5.2% growth in 2023, which met the government's targets, but was supported by a low base effect due to the previous COVID-19 lockdowns. The world's second largest economy is grappling with a series of challenges: a protracted property crisis, weakened consumer and business confidence, soaring local government debts, and a sluggish global growth landscape. This combination of factors has hindered a robust post-pandemic recovery. Data from the start of 2024 suggests a fragile economy, with faltering bank lending and a minor uptick in exports insufficient to stimulate domestic activity. The real estate sector, a critical driver of the economy, continues to struggle, with the government's efforts focused on reducing oversupply and aligning it with actual demand. Beijing's policymakers are under increasing pressure to implement more stimulus measures. The People's Bank of China has committed to boosting policy support to promote a rebound in prices. However, the central bank faces a dilemma, as more credit flows to productive sectors rather than consumption, worsening deflationary pressures and diminishing the effectiveness of monetary tools. The Public Bank of China has maintained the medium-term policy rate, despite market expectations for a cut, limited by ongoing pressures on the yuan. The government has already rolled out significant fiscal measures, including issuing 1 trillion yuan in sovereign bonds for investment projects. Further fiscal spending is anticipated to stimulate growth. Consumer inflation is expected to pick up slightly, reaching 1% in 2024 and 1.6% in 2025. In addition to the monetary and fiscal challenges, the property crisis and local government debt woes continue to strain the economy. The People's Bank of China's efforts to inject liquidity into the banking system are critical to inverting a funding crunch. However, the disproportionate flow of credit to manufacturing and infrastructure sectors, both suffering from overcapacity, is intensifying deflationary pressures. China's central bank is expected to cut the one-year loan prime rate in the first quarter and possibly reduce bank reserves requirement ratios if economic indicators continue to weaken. There's an urgent need for the government to accelerate structural reforms to boost consumption, a long-standing deficit in China's economic policies. The persistent deflation in China is increasingly causing international concern. The drop in consumer prices for 3 consecutive months and the contraction in producer prices for over a year highlight the weak domestic and external demand relative to the production capacity. This situation has led to an increase in exports of low-cost goods, intensifying trade tensions with Western countries. Despite the challenging economic environment, there are signs of a slight improvement in global trade, with China's exports growing at a faster pace in December. However, these gains are insufficient to significantly boost domestic demand. The fragile global economy, along with China's internal challenges, suggests a continuation of deflationary risks and potential need for more robust policy support to stimulate demand and counter these pressures. Former chairman of China Everbright Group, Tang Xiaoying, has been arrested on suspicion of taking bribes and corruption. Tang, who was expelled from the Communist Party earlier this month for severe violations and discipline, is being investigated further by the Supreme People's Court. Tang had previously served as vice chairman of China's top banking regulator, before becoming chairman of China Everbright Group in 2007. He retired in 2017. China has become the world's largest auto exporter, surpassing Japan, with gas-powered vehicles being the main driver of the increase in overseas sales. China's car makers have filled the void left by Western car makers in markets like Russia, where demand for gas-powered cars remains strong. The China Passenger Car Association estimates that China sold at least 5 times as many vehicles in Russia in 2023 compared to 2022. China's next wave of exports is expected to include more electric vehicles and hybrids. As the country's domestic EV markets slow down, China's automakers like BYD and Geely have seen significant growth in overseas sales. However, concerns about potential overcapacity and protectionist measures from other countries remain. That's all for this episode. We sincerely hope you enjoyed it and found the information provided helpful. If you have any suggestions or would like to discuss the topics covered, please feel free to leave a comment below. We'll be back next week with a brand new episode. Thank you so much for watching, and we look forward to seeing you next week. Take care and goodbye.